Good morning, hello and welcome. You're with us on Opening Bell and thank you for joining us on this live telecast. We're coming to you from Moneycontrol. I am Surabhi Upadhyay and the speech has happened. The markets have not liked what the US president has said. Essentially, he is saying that the US will withdraw. They are coming close to the completion of their objectives. However, at the same time, he's threatening that Iran will be hit hard, and I quote, will be hit hard over the next couple of days. He is now threatening strikes over Iran's power infrastructure, saying we could also take out some of the oil infrastructure. And in the meantime, the US president has said that the Strait of Hormuz needs to be opened by the countries that use it. So the speech essentially had nothing new. It was more of what we've heard before and read before on his Truth Social post. Let me quickly tell you how the markets have reacted, and not very well. That's the point that I'm making. So equities are down across the board. Asian markets are down anywhere between 2 to 4% right now. The Japanese market is declining, for instance, about 1.6, 1.7%. Oil has surged 5% up on Brent. We're back to levels of about 105, 106. Yesterday in intraday trade, oil had fallen to below 100. But clearly those comments that have come in just 2 hours back have not helped the market's cause. Now let's look at equities. Like I'm saying, most of the markets, the South Korean Kospi is down 4%, by the way. The Japanese market is down 2%. The Hong Kong Hang Seng is lower. So it's really playing out across asset classes. If you're seeing what's happening to the dollar, so that's the Hong Kong Hang Seng, down about 2%. If you see what's happening to the dollar, there is a move towards the so-called perceived safety of the dollar. So the dollar index is racing back towards the 100 mark, and bond yields, global bond yields, particularly US bond yields, are rising. That is the market's reaction. The market not too enthused after the US president's speech. Let's play you some of the key highlights from that speech.
We are systematically dismantling the regime's ability to threaten America or project power outside of their borders. That means eliminating Iran's navy, which is now absolutely destroyed, hurting their air force and their missile program at levels never seen before, crush their ability to support terrorist proxies, and deny them the ability to build a nuclear bomb. Our armed forces have been extraordinary. There's never been anything like it militarily. Everyone is talking about it, and tonight I'm pleased to say that these core strategic objectives are nearing completion. The United States imports almost no oil through the Hormuz Strait and won't be taking any in the future. We don't need it. We haven't needed it, and we don't need it. We've beaten and completely decimated Iran. They are decimated, both militarily and economically and in every other way. And the countries of the world that do receive oil through the Hormuz Strait must take care of that passage. They must cherish it. They must grab it and cherish it. They can do it easily. We will be helpful, but they should take the lead in protecting the oil that they so desperately depend on. So to those countries that can't get fuel, many of which refuse to get involved in the decapitation of Iran, we had to do it ourselves. I have a suggestion. Number one, buy oil from the United States of America. We have plenty. We have so much. And number two, build up some delayed courage. Should have done it before, should have done it with us, as we asked. Go to the Strait and just take it, protect it. The hard part is done, so it should be easy. And in any event, when this conflict is over, the Strait will open up naturally. Thanks to the progress we've made, I can say tonight that we are on track to complete all of America's military objectives shortly, very shortly. We are going to hit them extremely hard over the next 2 to 3 weeks. If there is no deal, we are going to hit each and every one of their electric generating plants very hard and probably simultaneously. We have not hit their oil, even though that's the easiest target of all, because it would not give them even a small chance of survival or rebuilding. But we could hit it, and it would be gone, and there's not a thing they could do about it. We have all the cards, they have none. It's very important that we keep this conflict in perspective.
All right, that was the US president just hours earlier, and like I've been saying, markets not too enthused. So before we get on, let's get a Moneycontrol in-house editor's take on what the US president has said. I have with me Bodhisattva Ganguly, Group Consulting Editor at Network 18. Bodhi, morning. Thank you so much for joining us. We had to pull you in because the markets are scratching their heads trying to make sense of what Mr. Trump is really indicating. And from the initial reaction, markets are not too happy. Your thoughts?
Yeah, so that's not a surprise, Survi. I think there was some expectation that Trump might declare, some kind of a ceasefire. Now, clearly, that has not happened, right? I mean, and I think what he said in the speech is really, I think, a compilation of some of the stuff that he has been saying on Truth Social over the last several days. Even the timeline is not clear. He talked about 2-3 weeks, but this 2-3 weeks was also said, I think about 2-3 weeks back. We are a month into the war, right? So, but anyway, if you take 2-3 weeks, literally, that would mean that the war would perhaps wind down somewhere towards the middle or the second half of this month, right? So the timeline isn't very clear. So yeah, the markets don't like what they're seeing. There is obviously a great deal of uncertainty in the world economy. There's also the problem is that which I think the US is facing, and that's increasingly clear, is that while from a military point of view, a lot of the things that President Trump said is obviously correct, that in the sense that Iran has no air defense, so the US and Israel can bomb virtually unchecked. So many of their leaders have been killed, their political leaders, military leaders, and so on have been killed. There's also, steel plants have been hit, power generating facilities, could be hit, and so on. So there's heavy damage which they've suffered to the military infrastructure. To some extent, it does appear their ability to fire missiles may have been degraded. So while all that is true, the problem is that Iran. So it's an asymmetric war, right, Suvi? So what Iran's game plan is that, unlike Venezuela, which surrendered after Maduro was arrested or abducted, however you may put it, I think there may be an expectation on the US side that on the first day after Khamenei was killed, that Iran would literally surrender. That hasn't happened. So Iran is simply by surviving, it has achieved a strategic objective, and it is able to inflict some damage. Yesterday, it fired missiles at Bahrain and hit, I think, a telecom provider, Batelco. It has threatened to hit, facilities owned by the big US, information technology. I mean, the likes of Google and Amazon and so on in that region. It's already done that. I think some AWS servers were hit. So it is doing enough damage. Not the kind, the damage done in Iran is far more, but Iran is able to do some damage, and there doesn't appear to be any off-ramp for the US. It's not clear how this is going to end and how the Strait of Hormuz could be, can be reopened. Yeah.
Absolutely. And also the fact that, and this is what experts have been saying, that even if the Strait were to reopen, say, tomorrow, that crude shipment for it to start for those facilities that have been hit, for them to come back on stream and start delivering oil the way it was happening pre-war, that's going to take some time. And I think those are the concerns that are playing out across markets, across currency markets, across bond markets, and of course, the equity market as well. Bodhi, just, your assessment of whether this may not be the ultimate declaration of the end, but does it look like this is the beginning of the end? Markets can take heart from at least that the military campaign should wind down. Till yesterday, the markets were really believing it. But then since yesterday, the Iranian side has also come in with a lot of denials, and a lot of different figureheads are speaking within Iran. And many of them are indicating that, no, we're not negotiating with the US, that this is a hazy narrative being spun. So the Iranian side also has not really given an indication that it really wants to come on board in terms of any negotiations, right?
Yeah, so Iran has clearly, shown a lot more defiance, courage, if you like, compared to, let's say, Venezuela, in the take a recent example. So they are not backing down. So there are a number of things. I think Iran clearly wants a negotiated end to the war, in which they want some kind of guarantees. They've also made see, there have been some reports that they want US bases around the region to be closed. I don't think there's any way the US is going to agree to that, and now nor will the Gulf, the local, the Gulf countries. But they would clearly want a guarantee that there's going to be no further attacks by US and Israel on them. Because suppose the war ends, let's say in 10 days from now, 15 days from now, they reopen the Strait of Hormuz, and 2 months later, the US or Israel, Israel has an existential fear of Iran, partly because of the political posture which Iran has adopted towards Israel in the last 40 years. So they could resume airstrikes on Iran. And Iran wants a cast iron guarantee that's not going to happen. So simply all this is up in the air, because there are some negotiations which have taken place via Pakistan, right, with messages being passed back and forth. But it's not clear how this ends and how the Strait of Hormuz is going to be reopened.
No, absolutely.
Whether it's absolutely, whether it's going to be reopened to everyone or only to certain countries with which Iran has struck deals. So nothing is really clear as of today. Something which markets don't like.
No, absolutely. Absolutely, uncertainty is what markets don't like, and there's plenty of it around. Bodhi, very quickly, last a minute on the chat. Now, boiling all of this down to India, the haze of war continues, the war of words continues, and the missiles are still flying, the threats are still out there. Boiling this down to India, I think what's most critical for us are two things. One is the price of oil, which is still elevated, still above 100, and second is what is happening to our macros, to our currency. Just quick thoughts on, what you made of several moves. And there was another move announced by the Reserve Bank of India last evening where they're looking to curb excessive, at least the speculation on the rupee. There is a genuine decline happening because we just need to import that much more. We need, those many more dollars. Our import bill is going to swell. But I think the RBI is trying to decisively cut back on speculation. The government has been, making the promise of ensuring orderly gas supplies. Just your sort of summation of the moves that we're seeing both here on Mint Street in Mumbai and in New Delhi.
No, so the RBI is doing what it has to do. It's very clearly the rupee is going to be under pressure. The question is to manage the decline and simply hope that the war ends in, I presume it will end in some weeks, however much you define some weeks. So the measures are all really textbook measures to curb what the RBI did just 2-3 days back, and now yesterday evening. In terms of the impact on the wider economy, I think there is very clearly going to be a decline in GDP activity. That is clear. There have already been downgrades to GDP growth by some of the brokerages. I think if the war ends in a reasonable time frame, let's say by the end of this month, I think the damage can be contained. If not, the damage will be more. There is anecdotal evidence that, let's say, the LPG shortage is resulting, for example, in some of the urban informal workforce, migrating from cities because they're not able to access cooking gas. So there is certainly an impact taking place. There is also an impact on industry. So overall, but the good thing on India is that India's macro fundamentals have been very stable for quite a long time. So we are starting off from a reasonably good position. But the best scenario to hope for is that the war does not continue for very long. But India seems less affected than some of our neighbors who have introduced already, work from home and such measures, also some element of rationing and so on and so forth. On the rupee, it's a question of managing some kind of the pressure which the rupee is undoubtedly under for absolutely, well understood macro reasons.
Yeah. No, absolutely. And we're 15 minutes away from the money market opening. Yesterday, the money markets were shut on account of the 1st of April. Today, let's see how much these measures are working, how effective they are. Dealers that we've been speaking to have been indicating that there should be some appreciation, some relief in the Indian currency because of the twin steps that the RBI has taken this week. Bodhi, thank you very much for joining in and weighing in on all that is happening around and, of course, the announcements from the US President this morning. Thank you very much. All right, very quickly check out some of the highlights of what the US President has said this morning. We'll come right back and get to today's trades and today's investment calls with our experts. Okay, so now what about today's trade setup and today's, today's entire proceedings? Because markets are under pressure, and the GIFT Nifty has been indicating that, like global equities, India will start off slow and perhaps very cautious. Aishwarya Dadeech, founder and CIO at Fident Asset Management, is with us. In a bit, we'll have Chandan Daparia of Motilal Oswal also joining in. Aishwarya, good morning. Markets are not too enthused or too impressed with what the US president had to say. And it's been a tough ride. What would your approach be to the market today?
Good morning. Good morning to all the viewers. I believe market was gradually straddling on risk-on sentiment over the last couple of days before what we heard from Donald Trump in his speech. We have to understand that this unpredictability or uncertainty is possibly here to stay for some more time. After, I would say, March madness, we might see some awful days in April also in the coming times. But having said that, my bigger worry is, the country like India, which has been showing resilience in the availability of crude so far, managing the availability of gas whole of month of March. And if this uncertainty stays for more than 2-3 weeks, possibly every passing week, things will become difficult. And it will have an impact on our growth, especially on the GDP side and the earnings side. So that is what I'm carefully watching through. But having said that, when I looked at what Trump said, and then where market was expecting that things will settle down anytime soon, and there was another 2 to 3 weeks of uncertainty, the reaction on crude and other market, I presumably believe, is not that sharp. Right, we are not coming back to 115 or 120 in a jiffy. I think market is still giving a doubt that this thing will get settled in coming weeks. And for a country like India, I would be very happy if we see some sanity prevailing, at least in the coming 2 weeks. So even if things settle in the next 2 weeks, I believe things will be manageable. But if it get elongated further, there will be a stark impact on earning growth and possibly on the GDP, and then FI selling will possibly continue from here onwards.
Yeah, and that's been the case so far, really, hasn't it? Aishwarya, stay on. Lots of people joining us on our YouTube live stream as well. So let me say hi to all of them. Narendra, Geetu, Vijay, Ashwini. Hello and good morning to all of you. I can see lots of questions there on individual stocks, and we'll try and answer as many as we can. Chandan Daparia is now with us, who, of course, heads derivative and technical research at Motilal Oswal. Chandan, good morning. Great to have you. Now, this market is becoming so difficult to trade. One day you get this 2% up move. Next day there's a slide 1.5%. So it's really, really choppy out there. We'll probably start with the gap down this morning. How are you approaching trade?
Good morning, Surbhi. Thanks for having me. So the market really yesterday opened positive, but again the excitement ended at the beginning as it fell to hold its opening level. And the important question is that still we are not getting the follow-up activity in the market. Yesterday, Nifty recovered by around 300, 400 points, but India VIX only gone below 25 marks. And somehow it seems that the index is just making the tune with the comment from the US President Trump, and that is very important to get the ease out from the geopolitical concern. And I believe we need to keep a couple of things in mind to find the market bottom. First, an important part is the cool down in the crude oil. Second, if rupee soften and holds below 93, 93 half. Third, an important part, cool down of the India VIX below 20 or 18 marks. And more important, the negation of lower top, lower bottom on the weekly chart on the Nifty. So until we don't get confirmation from all these four signs, I believe it would be tough for market to witness any sort of stability at higher levels. However, it may turn volatile because your India VIX is near 24, 25. If you look at the upside, immediate hurdle will be the tomorrow's high that is around 22,950 to 23,000, while on the downside it can go down to us 22 to 22,000 levels. Talking about Bank Nifty index, here also it witnessed some recovery. It was showing some resilience, but again, if the broader market remains in pressure, it will also find the pressure until it remains below 52,000. Bank Nifty can go down to us 49,500 to 50,000. So overall, the weakness could persist. Sell on bounce could continue till the market is not getting any sign of the negation of the lower top, lower bottom on the weekly chart.
Oh, absolutely. I completely understand your point. And then, so now even that sell on bounce, you can't sell at the opening because it'll probably open down. That's at least what the GIFT Nifty has been indicating. So is the sell on bounce trade, a good trade to do today, intraday? And if yes, at what level will you go short? And will you go with the Nifty or the Bank Nifty for this short trade?
Yeah, Surbhi, that is very interesting and deft question because we can't sell after the give down opening of 200, 300 points. This is the market where you can only sell when bounce is happening. Let's say if market opens down by 200, 300 points, let's wait and watch because this higher VIX can give the swings on both the side. Or second way is initiate the bear put spread. So my suggestion is if market, let's say open negative and witnesses any recovery, but till it doesn't surpass 22,750, use the hurdle of 23,000 for sell on bounce. And in that scenario, you can see the 22 marks. Other way, you can initiate some negative position on the selective weak counter, or the best way to wait and watch and initiate the bear put spread kind of strategy. Because at higher VIX, it's very tough to buy the option because any small move can collapse the option premium because of the multiple reason of the option Greeks and the change in the price sentiment also. So better to go with the spread or utilize any bounce to initiate short. Otherwise, better to wait and watch and keep the light position.
Okay, all right. So be nimble and don't rush in with a trade first thing because we'll probably get that gap down as Chandan is explaining. Okay, we need to get to individual stock trades and stock ideas as well. But before we get to that with both our experts, let's quickly run through today's stocks in news. A couple of the quarterly updates have started coming in. We also have some of the last auto sales numbers. So here's our list. Hero MotoCorp, March sales for the company are up about 9%, 8.8% to be precise, more or less in line with estimates. Motorcycle sales are up about 5%, and Hero Motors exports have done really well in March. Export growth is around 15.6%. So overall looking good for Hero MotoCorp. Speaking of auto sales, it's been a good March for Ola Electric as well. Total registrations have improved dramatically. There's a 150% rise in registrations for Ola Electric. They've come up to about 10,117 units in March, which is a big improvement over February. Force Motors total sales up about 14.4%. So that's one more auto stock on our radar. Speaking of updates, there's a production update that's come in from NMDC for the month of March. The company's total iron ore production is up a very healthy 51%. So good going from NMDC as well. Sales are up 40%. So it's been a good month for NMDC. Interglobe Aviation is going to be on the radar. Flying is going to get more and more expensive. The company has announced a revision to the fuel surcharge across both the domestic and international routes from the 2nd of April, which is today. The fuel surcharge for domestic travel has been revised between 275 rupees to 950 rupees based on distance. So there are different slabs out there. And for international routes, the hike is steeper. It goes up to as much as 10,000 rupees for certain sectors. So watch out for Interglobe Aviation. After that, let's look at a couple of order wins and Q4 updates. Space Digitech, mid-cap company, it has won an order for 495 crores from NTPC. This is for battery energy storage systems. V-Mart has come out with a Q4 update. Revenues up 24%, and the same store sales growth is at 12%. So that's V-Mart, which is in focus as well. And Prestige Group finally has secured a big parcel of land in Gurugram. The company says that the gross development value of this parcel could be 4,200 crore rupees. It's pretty substantial. So that will be on our radar. But plus a bunch of bank stocks have come out with Q4 updates, and we'll get to them in just a bit. Aishwarya, among the Q4 updates, I wonder which ones you saw last evening. Like I named a couple like V-Mart now, Karnataka Bank, Indian Bank. A couple of these banks also came out. So let's just go over what you liked, what you didn't like. First, the banks. What are the Q4 updates telling you?
So if you see, it's a couple of them like Karnataka, South Indian Bank, and all of them came out with advances growth number. The numbers are anywhere between 15 to 20% year on year. So it tells you that even if you see the fortnightly credit growth, it is taking around 14.5%. And when we saw this initial, quarterly updates from some of these banks, things are looking pretty sanguine from growth perspective. So at least the growth side angle is, market will not have to really worry on. We need to see more of those larger private banks numbers coming through in a couple of days, then we'll have more clarity. But the initial signs are encouraging. What market is really bothered about is if this issue elongates, and because of the gas and the crude and the inflation, there would be pressure on the MSME and SME segment. And that will start reflecting in credit costs sometime later in this calendar year. And that is why we have seen that kind of an impact on stock prices of many of these private banks and PSU banks over last month or so. But having said that, quarterly update is, I would say, just there are a couple of them, and they have given good insight so far. So I think that will give them much needed support that things are not all that bad. And we connect it to the GST number and the auto numbers so far, and some of the other like V-Mart and other players like D-Mart. That resilience of domestic economy is visible. And as we said earlier, if these things settle over the next 2 weeks or before that, possibly our ability to maneuver this tough time will be behind us.
So very quickly, Aishwarya, give us 2 or 3 top banking picks, a mix of mid cap and large cap banks.
So, after this drawdown in majority of the private banks and PSU banks, we believe it's better that someone stay with private banks and small and mid-sized banks and a couple of NBFCs. So we are very positive on players like Shriram Finance at these levels. We believe that their ability to maneuver this kind of situation has improved drastically, and its underlying CV and other asset classes have shown resilience. So I believe Shriram Finance at almost 1.4, 1.5 time price to book is providing a good level to enter. On top of it, if you look at some of the private banks, there is an obviously talk about some issues going on with HDFC Bank, but we believe more of them is noise. So they are providing a good entry level. So businesses like HDFC Bank, even to an extent Axis Bank, are our top picks in the private space. If we go down on mid and small size bank, there are a couple of them which we like. One of them is, DCB Bank, which we believe is again giving opportunity for investors to enter. They have shown good operational performance over the last 2 quarters, and that stock has been lagging for the last 4-5 years. So there is an opportunity there, and there are other players like there is player like Jana Small Finance Bank and players like that, which we believe are trading close to 1.1 time, 1.2 time book on trailing basis, and that given the kind of growth which is visible on the credit side, and once we are out of this wood, they will give a better growth visibility and possibly some kind of return for investors. So one has to be very choosy when they enter into BFSI space, or you have to be careful about valuation and make sure you marry the growth.
Yeah, absolutely. Okay, the pre-open session has kicked off, and what we have is, as expected, a gap down. It's not a very big gap down, but it's still 200 points lower. That's the point that Chandan was making, that it becomes tough to trade when you start 200 points lower. So let's see, okay, now what are individual stocks doing? Right now they're all over the place. A lot of the banks are pointing to a weak start. HDFC Bank, Kotak Mahindra Bank, some of the Axis Bank 2% lower. A lot of the non-banks like Shriram Finance also on the lower side of the screen. Geo is also, Geo Financial that is, on the lower side of the screen. Some cuts on life insurers like SBI Life. So in general, the BFSI space looks a little weak. Trent had a great session. yesterday. Some of those gains could be coming off the table today. At least that's what the pre-open is suggesting. It's opened down about 2-3%. That's pretty much it at this juncture. Interglobe Aviation surged yesterday because this hike in ATF prices by refiners, that wasn't as big as what the market had originally thought earlier in the day. It turned out to be far more measured, and in addition now they're hiking the fuel surcharge. So it worked very well for Interglobe yesterday. Today the stock's quiet. The stock is down about 2% as we can see. HDFC Bank is still nursing losses, 3.5% on the downside. So this is where some of the early trends are coming in. Let me check in terms of stocks and news if there's something really worth calling out. Again, a lot of the stocks that rallied yesterday, they are starting the pre-open session on a cautious note. So that would include the capital market stocks, that will include a lot of the defense stocks as well. Angel One, Cochin Shipyard, Motilal Oswal, these are some of the names. BSE, all of these stocks are slightly lower as we are starting off. Okay, speaking of defense names, let me go back to some of our viewer queries because there are viewers who've been talking about defense names as well. Ashwini's question was that at what level can we accumulate GRSE, Garden Reach Shipbuilders? I'm trying to deploy 2 lakh rupees. Okay, Ashwini, so let me pivot to defense and individual stock ideas then with Chandan now. Chandan, so let's leave the indices aside. It's too difficult, too volatile. Let's talk about stocks. What did you make of the big surge in defense names yesterday? I mean, some of these stocks were up 20%. So from a technical perspective, which ones offer a good risk reward at this point and also qualify whether it will be a short-term trade, just a couple of days, 2-3 days, or from an investment perspective, which stocks look good for both class of viewers?
Yeah, I think that's a very nice question. And I think on this decline, we should focus on taking few defense name in our portfolio. I'm using the word portfolio because it would be very tough to trade them on immediate basis because volatility is clearly there in the market. If you're a trader, then you need to strictly follow the key levels. First name will be BL, one of the strongest defense name. We have positive stance on the fundamental point of view, and in fact, on technical point of view, also the stock has negated its lower top, lower bottom. In last 16-17 days, it has seen a corrective move from 475 to 400 marks, and multiple supports are visible at lower level. So if you are a trader, use the support of 400, look for a recovery towards 450 to 460. And for investment and positional point of view, I believe you need to accumulate the counter 2 times with major support of 375 for positional target of 470. If I talk about GRSE and other name, I believe buy on decline could continue. On last trading session, counter rallied by more than 20%. Today, if any decline happens, you can accumulate it. Major support is near 2000. Keep that level in mind. With the support of 2000, you can use any decline for a positional target towards 2800. So BL and GRSE would be 2 preferred name where one can go with buy on decline stance. And you can also add HL. However, immediate structure is weak. But in terms of risk reward ratio, it favors the buying at current zone near 3500 to 3600 marks with the support of 3300. On positional point of view, it can go towards 4100 to 4250.
Okay, so HAL, Garden Reach Shipbuilders, GRSE, and even BEL, some names that Chandan likes. Aishwarya, thanks very much. I know you have to leave us now, so I'll let you go. Have a great day, and thank you so much for joining in. By the way, we have to look at the currency. The rupee is really reacting to the measures that the RBI has taken, and there is appreciation that's coming through. And this is despite the fact that globally the dollar has perked up. It's rallied because of the risk-off sentiment. Despite that, okay, we should refresh that trade because that is the closing. The rupee had closed at that level on what was it? It was actually Monday, yeah, because Wednesday we were trading, the rupee markets were shut, and now we're directly on Thursday. This was the close on Monday. The open right now has been a lot better. Let's refresh this rate and see if we can get the live rate. This was Monday's close. The rupee right now is at 93.62. It opened even stronger. It had opened around 93.54 thereabouts. Now it's at about 93.62. So this is really important because it's the impact of twin measures. What has the RBI done? RBI first on Monday came out. Yeah, that's the right rate. Correct. Look at the appreciation on the rupee. 1.3% up on the currency because of 2 reasons. On Monday, the RBI came out and told banks that they have to limit their net open positions, forex positions in the forwards market to $100 million. So that was one step that the RBI took to curb speculation. And yesterday was the second tranche or the second step, the second step that the RBI took. and these are the measures on your screen right now, the RBI has told dealers that they cannot offer non-deliverable rupee derivatives to clients, whether resident clients or non-resident clients. Only deliverable forex contracts can be offered. Basically, what this means is that the RBI is trying to cut down on the unnecessary speculation. Speculators and arbitrageurs who are looking to make hay while the sun shines, as I say, and play on the rupee's weakness. That is the element that the RBI is cutting down. And these measures are actually coming in effect immediately. And therefore, you're seeing such a strong reaction on the currency. Let's get the rupee back. I don't know, Chandan, if you track rupee charts as well, though I'm guessing, chart structures have been really destroyed. And even gold and silver for that matter. Everything has become so complex. Gold, silver prices collapsed again this morning after the US President's speech. The dollar index has been rising. So just in case you've had a look at any of these other charts, gold, silver, global dollar index, dollar rupee, just tell us what your analysis says.
Yes, Rupee, I track them very closely because while doing the inter-market analysis, most of these asset class matters the most, because we cannot only rely on the headline indices. But the problem is there is no clear correlation in most of these asset class in last couple of months. Rupee is continuously weakening. That means the USD INR is heading upwards. But only relief sign is we are getting some strength. But if you look at on week basis, USD INR is making higher top, higher bottom. If I look at the price behavior of last 8 weeks, it really moved from 90 to 95.67. If it goes below 93, then only there will be the stability. Even in my the comment on the market bottom out approach, I mentioned about the 4 asset class, and the crude USD were among the top 2. So if USD goes below 93, that might get the relief. But if it takes support near 93 and move back to 94, half 95, then there will be the concern in the market. Now to reply on the gold, what I notice if I look at the last 20 or 30 years data, I notice that whenever the war happens, usually the gold has tendency to move up. But this time the war is continuously going, but the scenario has totally changed. Even after that, the gold is continuously witnessing corrective move. If I look at the price behavior, we have seen some corrective move, but I believe some sort of stability could be there if I look at the gold price chart. If I look at the gold, this rolling price behavior of the gold current month series in MCX, I believe multiple supports could be there near 1,40,000. And if you look at in global terms, I believe 4,600 or 4,550 is major support for gold per se. If I talk about silver, I believe more corrective move could be there. In MCX terms, gold is major support near 1,42,000.
Okay. By the way, the pre-open rates have settled now, and we have a 300-point decline on the Nifty and over 800-point decline on the Bank Nifty. And the mid-cap index is down by about 1.2% as well. So let's get back to flashing some of the equity rates. Now, okay, Chandan, back to equities. What are the top trades? Like you're saying, forget the index. Now, with a 300-point gap down, you can't even short it. But other than this, what about individual stock trades? What do you have in mind for today?
Yeah, so I think we need to focus on the relative strength behavior of the selective counter. Try to focus on the stocks which really rallied well when the market was falling down. So I believe DMart is one name which rallied by more than 8% on the last trading session. In fact, now sentiment seems to be positive for the counter. And here, if you get the decline, better to buy. On last trading session, it closed near 42.70. If due to the market weakness, if we get the price near 4,100 to 4,150, one can accumulate with support of 4,000 for an upside target towards 4,350 to 4,500 marks. Apart from that, positive view on selective capital market theme. Mainly, I'll focus on the capital market infra theme like BSE and MCX. On last trading session, BSE rallied by more than 6%. Wait for decline. If it comes near 2750 marks, one can accumulate with support of 2650 for upside target towards 3000. And then can focus on selective metal and aluminum name. So Nelco will be the other counter. However, in last 5 days, it has been making higher top, higher bottom. But due to the weakness, if we get near 385, 390, one can accumulate for an upside target towards 420. So BSE, MCX, Nelco and DMart could be 3-4 ideas which are good to buy on decline because of the market corrective.
Okay, all right. That's very, very helpful for our viewers, Chandan. I'll just quickly throw a couple of stocks at you which are viewers are asking, just in case you've seen the charts. You may not be covering all of them. But there's a question on Craftsman Auto, Geetu is asking about Trent, and Trent had a great surge yesterday, right? After being absolutely decimated in the last 1 year. Yesterday, Trent had a good session. Today, it's suggesting a lower open. And then there are some questions on GAIL as well, GAIL and other oil and gas stocks. Just in case you've seen any of these charts of late, any interest, oil and gas name, something like Trent, anything else in auto or auto ancillary?
Yeah, so I'll start with the GAIL. It has been making lower top, lower bottom from last almost 8-9 months. Multiple supports are now visible near 130. So one can accumulate near 130. I believe 130 could provide major support because earlier the rally started from the same level and counter headed towards 240, 250 marks. So buy on decline near 130 for an upside bounce towards 150. If I look at the trend, structure is clearly negative because it has been making lower top, lower bottom even on the monthly chart. And if I look at the last 18 months, it had seen a corrective move from 8300 to 3500. So structure is weak. But yes, on short-term point of view, it seems that now counter is gone into the deep oversold territory. If you're looking for bounce, then only apply. Otherwise, wait and watch. Major support is near 3250 for a bounce towards 3750. If you look at the Craftsman, I think Gitu asked about the same. I think it's consolidative nature. Don't buy all the quantity at one go. Try to buy in 2-3 times. Utilize the decline towards 6000 to 63 as a buying zone in the counter for a positional target towards 7500 to 7800.
Okay, all right, Chandan, thank you so much for your time this morning. Another difficult day, another confusing day, market getting whipsawed, but you really helped us make sense of how we can navigate this volatility. Have a great one and have a good weekend as well. It's a long weekend, something to look forward to, right? And we'll catch you again soon. Thank you, Chandan.
Thank you so much, Sulbi. Have a great time.
Thank you. Okay, now very quickly, before we get to the market opening, let's put the spotlight on the defense space. We just were taking some calls with Chandan as well. He likes a couple of defense stocks. Tejal Parab, who tracks the defense space at Moneycontrol Pro, is joining in. She looks at these companies very, very minutely. So quick fundamental check with Tejal. Tejal, thank you so much for joining us on Opening Bell. Great to have you on the show. So I want to start with what these companies delivered in FY26, because yesterday the stocks were very excited, despite the fact that some of the companies like HAL missed their original targets for FY26. So first of all, let's go over the report card. What did you think of the major DPSUs in terms of their target versus the actual achievement at the end of last fiscal?
Yeah, so HL had a challenging year, reporting 4% revenue growth, missing its target of 8 to 10% revenue growth. Due to supply chain issues and Tejas fighter jets delays. In contrast, Garden-Rich Shipbuilders have achieved 6,400 crores of its sales this year with a 26% jump, achieving its target of 25% growth this year. Further, Bharat Electronics has outperformed its expectations, achieving 16.2% growth at 26,750 crores of sales, exceeding 15% of its revenue, and Midhani also was close to its goal of 1,300 crores of revenue, achieving 1,206 crores of sales due to raw material challenge.
Tejal, just stay on with us. You have, just finished on cue. Give us 2-3 minutes. The equity market is just opened. Let's go over the rates and then we'll come back to this defense conversation. It's a deep cut. It's a 400-point cut. It's worse than what the pre-open session was indicating. And it's tough. The Nifty is struggling well below even the 22,300 mark, 22,250 on the screen right now. So immediate reaction. And a lot of yesterday's hard work gets undone in a flash. That's the problem with the market. Yesterday we had started higher. We had not closed at the high point of the day, but we had held on to at least, the bulk of those gains. But this morning is very, very different. Okay, let's see where the pain is. The mid-cap index is much worse off. 2.4% lower on the mid-cap index. The bank nifty is sliding 2.5% down on the bank nifty. So the nerves are really out there. Let's take a look at the Nifty. Now, where is the fall the steepest? Interglobe Aviation down 5%. Imagine, you're trading on so much of sentiment and some actuals. The actuals are the ATF price hike has happened. It's not as steep as what perhaps the companies had feared. So that's good. They've also revised the fuel surcharge higher, but yet Crude prices are still up and the sentiment is negative. So Interglobe starts as the weakest stock on the Nifty. It's down 3.5%. It has plenty of company. Shriram Finance, Sun Pharma, Adani Ports, Eternal, Asian Paints. It doesn't matter, right? It's one of those completely sell-down moments once again. L&T is down another 3%. Trent, which was recovering yesterday, is again down. A lot of those gains are coming off the table. 3% down on Trent. State Bank of India, Mahindra and Mahindra. A lot of financials week. Actually, let me check out the banks. The Bank Nifty is down, 1,300 points lower on the Bank Nifty. So let's keep flashing more Nifty losers and you'll see a lot of banks coming up on that list. Kotak Mahindra Bank is down, SBI is down, Axis Bank is down between 2 to 3%. And some of the bigger names, let me just check what HDFC Bank and ICICI are doing. HDFC Bank is starting about 2% lower, ICICI Bank is down about 1.6%. And even non-banks are, getting really lashed out. Bajaj Finance 2% lower, for instance, at this point in time. Shriram Finance is sliding 3% as well. So it's really, really one more tough morning. Not a single Nifty stock on the positive side. The reason we are showing you only losers is because there are no gainers. Everything is down. Little bit of a green on Coal India, did I say? Not even that. Coal India's e-auction prices have increased, so that's good. But this is not the kind of market that's latching on to good news at all. So basically, all stocks on the Nifty are lower. Let me look at some of the other movers and shakers. A couple of banks came out with their quarterly updates. Indian Bank, for instance, the advances picture looked okay, but again, the stock's down 3.5%. BPCL is lower, HPCL is lower, BPCL, HPCL down 3-4%. You have other mid-cap losers on your screen. Bank of Maharashtra down quite a bit, 4% today. Names like Astral, Godrej Properties, all of them on your screen, down quite a bit. Oberoi Realty is down about 3%. Prestige announced that they've got a big land parcel in Gurugram. Hasn't helped the stock, down 3%. None of the news announcements here and there are really adding to anything today. It's just a downbeat market. 2.5% gone from the mid-cap index. Let me see if there are any other big names to call out. SRF is a big one, down about 5%. Emcure Pharma is down 5%. Garden Reach Shipbuilders, which was rocketing away yesterday, almost 20% higher, is down 5%. So some of those gains are coming off the table. We'll keep flashing the rates for you. But to quickly complete that conversation with Tejal, who's the Moneycontrol Pro defense analyst. Tejal, so you explained that for some companies like Garden Reach, it's actually been a good close. HAL has had its own issues and they're well documented in the market. The question is now FY27. What should investors watch out for? Which are the defense companies, either PSUs or private sector, where the execution pickup is likely to be strong, where the actual P&L recovery could be good and something to watch out this year?
So as we are entering FY27, defense sector is poised for growth due to its large order books. Hindustan Aeronautics and Bharat Dynamics, they are leading with their large order books, which is around 8 times its annual revenue, followed by Cochin Shipyard, which is trading at 3.7 times its annual revenue. So mid-tier players like Bharat Electronics, MDAR, GRSE, they are also having healthy order book ranging from 3 to 4 times of its revenue. So they are indicating a stronger revenue growth, visibility and steady growth over the next few years.
Okay. And finally, in terms of valuations, I mean, it's always visibility in terms of more order wins and better execution combined with valuation. So which of the stocks has the best valuation comfort and then therefore, the best risk reward proposition?
So in terms of valuations, Bharat Electronics and Hindustan Aeronautics, they are moderated after the post-March correction. So BL is trading at around 38 times its FY28 earnings and HL is trading at 22 times its FY28 earnings. So the decline was largely due to profit booking after a strong rally and its stretch valuations. Despite these corrections, BEL and HAL are reasonable at current levels, providing its large order book and sector tailwinds.
Okay. All right, Tejal, we will leave it there. Thank you very much for joining in with your quick analysis. That's Moneycontrol Pro. And I think there's another report on defense stocks that Moneycontrol Pro is releasing today. So we urge all the viewers to go online, subscribe, and you can get more real-time analysis and stock ideas, of course, on Moneycontrol Pro. Thanks, Tejal, very much for joining in.
Yeah, thank you. Thank you.
Okay, now it's time for us to introduce, thank you so much. It's time for us to introduce our big market voice on the show on Money Control. And as we do that, the market's voice is actually really bleak, 450 points lower. And the struggle at 5 times 2. What do I mean by 5 times 2? The index right now exactly at 222222. As we welcome in Pankaj Tibrawal, founder and CIO of Ikigai Asset Managers. Pankaj, good morning. What a pleasure to connect with you on Money Control. It's been a while since we spoke. Great to see you here.
Same here, Surbi. Good to connect with you after a long time. World has changed.
I know. The world has really changed, and I think all the viewers who watch our live stream, plus who read and listen to these recordings, even on the website, they can really do with your wisdom. Now, Pankaj, where do I even start? Like you said, 1 month and the world has changed. I think if we had this conversation, and we did have you on Money Control after the budget, just around the budget. I mean, India's story was looking very clear. This was supposed to be the year of India. FIIs were supposed to come back. Earnings were supposed to recover. How much of that has changed? To what extent in the last 1 month?
So let's look at the first part. I think that predicting the next steps or outcome of the current conflict with Iran is difficult, given the hard choices Iran is facing and unpredictability of President Trump. However, one thing is very clear: no matter if it escalates into a ground war or ends with another de-escalation or ceasefire, it will be virtually impossible for the world to return as it was prior to February 27th. So that's the base thought. And you now look at from a macro setup perspective. I think from an India perspective, we are far well positioned entering into this crisis compared to the previous crisis. Why I am saying so? Over the last 4-5 years post-COVID, our fiscal was in control. Our current account was about 1.2% of GDP. And the thumb rule is every $10 of barrel is about $15 billion incremental of CAD. And don't forget our new tolerance level of oil, which used to be a decade back about $60, $70, is about $90 in our view. Because the services exports, which was about $80 billion in 2019, is about $240 billion. From a strength perspective, our oil intensity has also gone down, and renewables as a portion of electrification has been a very decent pickup over the last 5 years. And over and above that, the corporate and the household balance sheets are not levered compared to the previous cycles. So the macro setup which we have entered into the crisis is far more strong than we have seen in the previous cycles where people used to worry about it. Having said setup, I think corporate India, in our view, actually gains from a little bit of inflation. Over the last 3 years, we saw deflation across commodity prices. Only volume growth was the support for all the listed corporates. A lot of small SME players were mushrooming when there's a deflationary situation, leads to competition. The opposite is happening in the last 30 days. And I tweeted it on just a few days back. Overall, telling us the ground situation, what it is. What is the ground situation as we speak to more than 100 corporates over the last 30 days? The first fact is there is no visible demand destruction. On the contrary, a large number of corporates are sounding extremely bullish on the demand environment as we speak today. Can there be demand destruction as pricing starts to get passed on in April and May? Answer is yes. But is the demand environment absolutely bad, saying that order cancellations happening? Answer is no, it's the reverse. Even we spoke to auto ancillaries, they said that the schedules which have come from OEMs for April and May seems to be quite strong. And overall, there is a supply shock which has happened in terms of raw materials and supply chain. And hence, companies are not complaining about demand, but what they are saying, our entire time is going on managing raw materials, the entire supply chain, the workers, and etc. The second most important feedback was that small corporates, small SME segments, especially out of Surat, Rajkot, and other places, the workers are going back to their villages. One, because of the gas supply. Second, because of the uncertainty and the third because of elections in few states. So I think that's where smaller companies are having worker issues. The third portion is that many companies are trying to enter into short-term contracts now because the commodity prices have shot so significantly that they don't want to get locked into longer-term or medium-term contracts. And contracts have now turned out to be fortnightly or max monthly because no supplier or the buyer wants to get locked into higher prices. What does it mean for corporate India? So when I look at this slightly from medium term perspective, I don't think oil will revert back to $60. That's our view. I think the new benchmark for oil could be $80, $85, which in my view is a sweet spot for India, nothing major to worry about. And if that happens, you would see a little bit of inflation across all the product cycle of petroleum chain and many other commodities, which is good from a corporate India perspective. And if there is a 3.5%, 4.5% inflation, your nominal GDP turns out to be 10.5%, 11%, which is good from a India top line perspective. Mind you, for the last 12 quarters, we had a single digit top line growth, which was weighing up. Corporate India was working extra hard to extract margins, and that was supporting earnings growth, but top line growth was missing. Now, with inflation coming in, nominal GDP moving to 10.5%, 11%, we believe that the top line growth could be higher, which will absorb a lot of your fixed cost, and hence the EBITDA impact, even there is a gross margin impact, the EBITDA margin impact may not be as high. And hence we believe if our base case suggests if the war ends or ceasefire happens by April, then there could be a 2 to 3% downward impact or revision on earnings for FY27, and not that much. April and May could be a tricky one because new raw material goods starts to come in, and how that gets passed on to the end consumer, we have to see. But demand overall on the ground remains very strong across the board, especially B2B businesses. We have to see how it goes as you move ahead. But I am not negative at all. After a long time, I have gone extremely positive. And I think this chaos, this correction is a brilliant opportunity because after a long time, you are able to see companies at your valuation. If you take a slightly medium to long term view, I think in 2 to 3 years, you are seeing many companies where earnings could double. And if that's the case, you have to cut this noise out because when you are in a crisis, it's the most uncomfortable position for anybody. But on the hindsight, that looks like an opportunity. So 12, 18 months down the line, when we look back, I think probably this crisis will come out to be a biggest opportunity. And the same playbook, Surbhi, is getting played out. 2018-19, market consolidated, corrected, time corrected. As people were starting to get positive in the early part of 2020, COVID stuck. It was a global event. You saw in March 20, there was a mayhem. People said that what will happen to lives and others. And that formed the bottom of the market. And for the next 3 years, you saw the market returns being extremely high. The same playbook is played out here. September 24, markets peaked out. February, India corporates were looking good. Macro setup was looking good. Markets were turning positive. May, the Iran global event happened. And again, markets tanked by 12 to 13%. I think if you slightly take the medium-term call and if the ceasefire happens, I can only tell you that the corporate India is very, very well positioned. And in an inflationary situation, the market shifts normally starts to happen from unorganized to organized. The smaller guys may not have the bandwidth to get a working capital credit at higher commodity prices. They will not have, balance sheet cash flows to manage the volatility. So market share intuitively shifts to larger guys.
Pankaj,
and I think that's a very good thing.
Pankaj, that's a brilliant explanation of why you're feeling so optimistic. And it's not just about valuations and you can buy stocks cheaper, but the way you are reading this, how this will play through companies and corporate India. And you're someone who looks at companies with a very, narrow, sort of very deep lens, a magnifying lens, right? Down to the micro level. So I completely take what you're saying. And for the benefit of viewers who might be joining in a little late, let me just recap what Pankaj is essentially saying is that the hit on corporate India because of this war will not be as dire as I think what some analysts are suggesting or what sentiment is suggesting at this point in time. He sees only a 2 to 3% downward revision in earnings estimates for FY27 for the year as a whole, which is quite something. Now, but just to play devil's advocate, Pankaj, while I take your point, there's no demand destruction as yet. Demand destruction usually happens if there is other types of disruption for a prolonged period, right? But even if we talk about the supply chain disruption, the labor issue that's really important that you spoke of, that itself could be problematic, right? And on top of this, so this is obviously the nuts and bolts of how companies are managing it. But on top of this, we have to add the other market dynamics. That is the constant FPI selling. Now, with India being so exposed to, higher global oil prices and the macros looking a little iffy and the rupee sliding, that FPI selling is bound to continue. So won't that create its own challenges?
So there are two different parts to your question. The first part is corporate India. And hence, what I said was the medium to large corporates who are leaders in the sector generally tends to do far better in an inflationary situation rather than a deflationary situation. Let me give you a small example. Look at a PVC pipe manufacturer. The PVC prices have gone from 60 rupees to 110 rupees, which means about 70-80% increase in the PVC prices. Now, a small guy who is a regional player will not have the working capital credit limit to store inventory of that 70-80% increase. Secondly, if prices come down tomorrow from 110 to say 90, the 20 rupees inventory loss, a large corporate will not even blink, but a small guy will get vanished because his balance sheet may not support it. So intuitively, in such a volatile situation and inflationary situation, what we have seen in the previous cycles, the market share starts to shift to the incumbent and the leaders of the sector, which are good in terms of their cash flows, balance sheet, and supply chain. And large suppliers will also like to associate with them. And even on the worker side, let me give you a feedback from ground. Many corporates, what they are saying to their workers, please don't go back to your villages. If there is a gas problem, my canteen at the factory will give you breakfast, lunch, dinner, not only for you, but for your entire family. If that's your concern that you're not getting gas to cook, please don't go back to your village. We will help you and support you. Can a 20-30 employee kind of a establishment or a factory can do that? Answer is no. So the point I'm trying to say is that they are better equipped to handle the situation. And this time the corporate balance sheets are in much better shape compared to 18-19, where we were hearing about IBC, where we were hearing about everything. And hence this time is the first time, at least I have seen in my 26 years. In 26 years, Surabhi, that mid and small caps have actually started outperforming Nifty. The broader market in the last 2 months have actually done better than the Nifty, right? Now your second question comes to the FPI part. Obviously, there is a lot of concern on how the macro setup will be, how the demand destruction, because we are net importers of oil and energy, and how the things will shape up going forward. And that anxiety is leading to a lot of money getting seen outflow. So just to put things in context, it's not only India. Taiwan, which is the darling market, has seen till mid of March about $22 billion of outflow. On a trailing basis, Korea has seen much bigger outflows than India now, despite the markets being positive year to date. So Asia overall as a pack has seen huge amount of outflows in the month of March, the highest ever. 50 or $60 billion have gone out in a single month out of Asian markets. So it's not only the India phenomena, but what good has happened, Surbi, is that this time around, Korean markets have shown that they can correct 10% in a day, circuit down, because 2 or 3 stocks make up for the entire index, which is SK Hynix, Samsung, and others. Similarly, in Taiwan, you saw in a single day circuit down. At least markets will start appreciating, FIs will start appreciating over this once the crisis gets over, that Indian market is far more diversified, better quality. Top 10 stocks are just 33% of 34% of the index. And hence, at some point when the demand or the supply chain normalizes, India is a country to bet on. So if you ask me, I think this year towards the second half, I'm quite hopeful that FI will return. And at 17, 18 times 1 year forward P, Surbi, we are back to the averages. The dollar returns have not been that great over the last 3-5 years. So from a FI perspective, this could be extremely attractive entry point. And this entire crisis, India had stood out politically, diplomatically, and from a macro setup much stronger than what people would have expected 4 years back. So I think that I am not very concerned on the FPI side. They will come back. And at some point, government will unleash a lot of reforms. You are already starting to see that. And I am quite hopeful that this sharp sell-off, which we have seen in the last 30-45 days, is a brilliant opportunity for somebody who was looking for correction, wanted to increase equity allocation. Don't think about it over the next 1 or 2 months in a staggered manner. Start increasing your equity allocation. At the ground, nothing much has changed, though there will be some demand destruction, demand postponement, which is inevitable. But I think corporate India is in a much, much stronger position as we speak today.
Oh, and as you were speaking, Pankaj, by the way, the dollar-rupee equation has improved dramatically, almost 2% appreciation on the rupee. And that's all thanks to the RBI. The RBI coming down literally with a stick to curb excessive speculation. Twin steps announced in this week itself, and they're really beginning to bear fruit because banks now have to limit their positions to that $100 million. They have no choice. They have to wind up excessive positions. And dealers have been told that they cannot take non-deliverable contracts, derivative contracts, and offer them to their clients. So it has to be all deliverable, real hedging. There cannot be speculation. And that's what the RBI has done. And the result is on the screen this morning. Pankaj, I actually completely take your point. That's a very convincing argument again, and kudos to you. Even on the FPI selling, because that's so true, right? We've seen that in this phase. One day Korea is up 6%, one day it's down, 8%. This morning, I think it's down some 4-5%. So it is a very volatile market. It behaves more like a mid-cap stock than a large, diversified, asset class that you want to be in. And investors will have to learn to live with that volatility, those who choose to be in Korea. So, okay, now that you've completely convinced us that indeed it's not as dire, the next couple of months should bring better times. The question is, if someone is really, and this is a great time to totally overhaul your portfolio, rejig, remove what's not worked, really add the, the good quality stocks that would at elevated valuations. So now help our viewers, let's say if someone is starting afresh or putting in a large chunk of capital afresh, how should that portfolio be designed? What do you like in this market?
So, Surbi, what you like is secondary. I think what not to do in this market is most important. And I think that goes back to the investing side, which I've been talking about for last many, many years, that when a correction comes, the real test of a fund manager will be coming to fore, that in terms of portfolio construction. And I think you should be extremely wary of leverage companies. You should be extremely wary of companies where you think valuations are skyrocketed. And if earnings don't follow that, there could be massive derating. And you should be aware that you should not be supporting weak cash flow companies. So these are don'ts that should be part of your hygiene list, and hence the lens you have to use that. Apart from that, what are we seeing where we are positive? I think few segments which in my view would see acceleration in earnings as you move ahead. The first one we have talked about in the past, and I think this war has been an inflection point, is the entire chemical sector. I think they were struggling because of Chinese imports. There was a huge pressure from China. Now the situation is such, when we speak to all the chemical companies, that people are queuing up. People who are buying from China because of logistics, rupee depreciation, and the pricing going up in China as well, they are finding it difficult from their import perspective, and they are turning back their supply chains back to the Indian manufacturers. So I think they are seeing very strong demand. Pricing has moved up, and hence the revenue growth, which was sluggish, because of the price increase and volume together, they will see double-digit growth in our view going forward. The second is the entire auto ang space, which are pivoting themselves from auto to non-auto. And we see very strong demand traction in defense, aerospace, and semiconductor. And hence our preference for few of the auto angs, where underlying also business momentum is good, and also side by side pivoting to non-auto sector. The third is the entire financial pack. I think after a long time, private sector banks are looking extremely cheap. And our basic thesis now to back private sector bank is that over the last 2 years, you saw huge competitive intensity in retail by PSU banks because the corporate offtake was very weak. Now, with working capital credit limit going up and requirement going through the roof, you think about OMCs now needing much higher working capital. Who will supply that? It's PSU banks. A large number of corporates need very high working capital. Who will do that? Private plus PSUs combined. And hence, our belief is that the competitive intensity in retail by PSU banks, which were a problem for growth for private sector bank, will start to subside substantially, and you could see much better growth on the retail side by large private sector banks. And valuations have materially derated. And at this point of time, the risk reward and margin of safety continues to be very strong. The fourth place is the home building products space, where you are backing the tile manufacturers, you are backing the PVC pipe manufacturers, you are backing the plywood manufacturers, and the entire space, because of the unorganized having trouble. For example, Morbi is completely shut down. Companies which are out of Morbi, the listed guys who are in north and south of India, and GAIL is supplying them gas, they are in a much better position to cater and gain market share. So that's the home building product segment where we believe there is a reasonable amount of earning acceleration we can expect going into FY27. And these 3-4 years, they have done nothing in terms of stock prices, and their valuations have corrected meaningfully, offering growth. The fifth one is the entire consumer discretionary sector, which could include retailing, which could include consumer durable, wires and cable, and so on and so forth. So that's our entire bucket. And top it up, the overall broader theme on commodities remains extremely intact. I would recommend that every investor should have some exposure to hard assets, because as I said, world will not be the same as before 27th of Feb, and every country will look inwards. Just one small example, tungsten, which goes into missile drones, tungsten, which goes as a metal, it is a rare earth metal, right? For every defense equipment, you need tungsten as a raw material, a small quantity. China controls 75% output of that. Today, there's a huge shortage of tungsten, and the stock and the prices have just doubled in the last 45 days since China restricted the export. Now, if the war was to go on and you have to readjust your supplies on inventory on the defense side by US or anybody, you need tungsten to manufacture basic missiles, drones. How will you get that raw material? So I think
but how do you take exposure? But Pankaj, the question is, now Indian investors sitting here, how do they take exposure to a tungsten? I thought when you said hard assets, you said basically go back to gold and silver. But how do you take exposure to these commodities, these rare earths or these metals?
So the non-ferrous is clearly there. Non-ferrous stocks are there. Ferrous is also doing very well. I think steel stocks will surprise you on the earnings for the next few quarters. The kind of spread expansion we have seen in across all the steel companies. And if you have wherewithal, there are ETFs globally which kind of cater to your rare earth, you cater to your copper, aluminum, so on and so forth. And there are avenues, and through different advisors, you can just connect with them to invest in those global ETFs. But I think hard assets, either you can express yourself through precious metals like gold or silver, or through non-ferrous or ferrous, should be some allocation to your portfolio, because we are entering into an inflationary situation in the world where hard assets will become more and more valuable as you move ahead. And trust me not, you have started to see one very big trend, Surbi, that the Magnificent Seven has started to underperform S&P. And don't forget that this is the most owned 7 stocks in the world. And that shift is starting to happen to energy, materials, defense. So there is a sector rotation inevitably starting to happen globally. And every person is exposed to the Magnificent Seven globally now. And that underperformance at some point of time will make sure US markets underperform. And there is a huge sectoral shift which can happen from software, from all these Magnificent Sevens to the hard assets. I think the next 3 to 5 years, you need to have some allocation, hard assets, whether you take in form of global ETFs, whether Indian ferrous, non-ferrous, or gold, silver is your choice. But some part has to be in the global portfolio, in your overall portfolio. That's our belief. We may go wrong, but I think energy
got that.
Energy shock, absolutely.
Very, very interesting points. I mean, and I guess it's true, right? I mean, even the best of IT and digital ultimately relies on chips. Chips rely on some of these rare earths, and therefore the circle is only complete when you have those hard assets and those rare earths and those specific metals available abundantly. So I take your point. Very interesting thoughts and plenty to chew on for our viewers as well. You've given us a fair amount of idea in terms of the parts of the market that you think will perform well, and your reasoning as to why you think that this is still a great time to build long-term portfolios. Pankaj, always a pleasure having you. Thanks for joining in, and we look forward to more of these exhaustive sessions on the market. Thanks. This was a bit of a masterclass and very timely and much needed. Have a great day, and we'll connect again.
You too. You too. Thank you.
Thank you. Thank you. Thank you so much. Okay, so by the way, one of the things, and that's actually a nice segue into our next discussion, inflation and hard assets. Now, inflation and what crude oil is doing, what's happening to our macros, and what's happening to both our bond yields and the currency. That is our next subject of discussion. Before we get into that discussion, just a very quick check. The Nifty is still down about 400 points. Check out just very quickly some of the top brokerage recommendations of the day, and then we come back with our next set of guests and turn full throttle on the macros. Welcome back. Well, as promised, we've discussed the equity market for a good bit. It's time to really turn our eye on the fixed income market, on what the rupee is doing and what's happening with Indian macros, because that's where the concerns have been only growing. Abhishek Bison, head of fixed income at Kotak Mutual Fund, is with us. Abhishek, thank you so much for joining in, and thank you for being patient. We were just winding up that conversation with Pankaj Tibrewal, who essentially was with Kotak till a couple of years back. But Abhishek, now we just need to understand, because I think the equity market aside, the bigger worry, I think for slightly more savvy investors, is what the bond market here in India is indicating, what the currency market is indicating. Because on Monday, there was near panic as the financial year was ending, right? The benchmark yield topped 7%, the rupee was sliding to 95. The rupee is recovered, doing much better today thanks to the RBI's measures. But what have you made of what this 1 month crisis has spelled for Indian fixed income markets?
Yeah, hi Surbhi, a very good morning to you and thank you for having me on the show. So, as you rightly said, it has been a panic, completely panic all across asset classes, and especially fixed income. The entire year has been under stress, and which has in the last 15 days has been, in fact, even worse. But if you look at all the asset classes, be it currency, be it commodities, or be it equities, then fixed income at least offered much relatively better shelter. So it gives in importance to the asset allocation part of it, which we have been highlighting. But coming back to the macro part of it, at this point in time, as we speak, fixed income markets are assuming that oil prices, which is shot up above $100 a barrel on oil, and in fact 105, 110, 120 also we saw, are assuming that it is going to remain at these level for the at least next 3 to 6 months, or in fact a year as well. Both fixed income and currency markets are assuming this fact to remain, and it is going to have an inflationary impact, of course. Now, there are two parts to it. A, whether the government is allowing complete pass through to the customers, or government is going to absorb significant part, as they have done in the recent past by cutting excise duties. So, if you look at part B, where the government is absorbing, then it impacts the fiscal math, and the bond supply goes up, and therefore bond markets are worried. But if you allow a complete pass through, the inflation goes higher, and it becomes a negative growth shock. This year we may have a reasonable amount of inflation problem, but going forward it is going to base effects will come into play, and the inflation may not appear to be as bigger problem later on, but definitely it is going to impact growth negatively. So once growth becomes a negative picture, then it complicates the job of the RBI in terms of what has to be done. Because if you tighten the monetary policy as of now because of inflation, next year you may have to, the job will become bit complicated, because inflation may appear low, but at the same time growth may appear even lower. So having said that, if you look at the implication of the fixed income markets, more to do with liquidity, the complex FX situation what RBI has been facing, as you rightly started with the rupee dollar situation, where rupee depreciated significantly given what is happening around the world. After the measures, we've seen reasonable amount of correction in the rupee, and the rupee is back to around 93 mark. Probably it is going to stay here because the measures are reasonably okay. So now the rupee situation is coming under control. It should have some amount of soothing impact on the fixed income markets as well. But markets are forward looking, and markets, as I said, have discounted these events for remaining for a fair amount of time, which may not. So if you look at the front end of the curve, 1 year shorter end paper CDs are trading at around 7/4. In fact, 3 month became at saw a high of 7.5. And at the longer end, if you look at the 30-year bond or the 10-year bond, as you said, 10-year bond touched at 7%. At the same time, 30-year bond was trading at 775, 780. And the state loans are trading upwards of 8% as well into certain segments. So these markets are discounting a significant amount of tightening already, expecting the RBI to act, which may not happen in the near future because of this complex situation, as I explained it to you. Therefore, bond markets are offering reasonable amount of safety. Yeah.
No, so
Yeah.
Abhishek, just sort of to take this step by step, by the way, the 6.48% 2035 paper, that 10-year paper, the yield is still above 7% on that even this morning.
Right.
So the rupee has stabilized because of RBI's various steps and measures, but the benchmark bond yield is still hardening. And Abhishek, the hardening has been quite substantial, right? In the last 1 month, just the month of March alone, in order to price in this new reality, I think the benchmark yield is up some 37 to 40 basis points. So what is the market right now saying? Is the market saying that at some point we'll get a rate hike this year in 26?
Yes, so as you already said, 7% still it is hardening. So if you look at other parts, what is happening, as I explained it to you, the 30 years of trading at 780, it is even discounting a further more tightening measure from the RBI. So if you
Oh,
look at the swap rates, which do not have any constraints in terms of SLR requirements, or it's a free expression of interest rate. Hello? Yeah, it's a free expression of
yeah,
interest
yeah,
rate,
Abhishek, we can hear you
and
now. In between, we were losing you, but we can
yeah,
hear you now.
yeah. So better indication is through 5-year OIS. The 5-year OIS is trading at around 675. So it is discounting a 125 basis point rate hike in the near future itself. So markets are into that kind of territory where they are discounting. As I said, they are assuming oil to remain at these levels for the foreseeable future, and therefore RBI will be forced to act. And they are already pricing in a 125 basis point rate hike. And if you assume that to be true, the 10-year benchmark yield is not yet hardened as much as it could have, assuming 5-year OIS and the 30-year bond. So they were the lead indicators. They are already at a level where it, assuming a repo rate of 6 quarter to 6 half, they're already trading at those levels.
Okay, Abhishek, stay on. We also have Indraneel Pan joining in to give us a bigger macro perspective on how macros are shaping up, because that's what the markets are reacting to. He's of course the chief economist at Yes Bank. Indraneel, thanks so much for being with us. And I remember your recent note. I think just 2-3 days back, you had released a note that said that actually, despite all these RBI interventions and the new measures that they've taken, the rupee can actually head to 97. So let's start
Yeah,
right there. If you could just explain that call, why do you think that so much of weakness is ahead?
okay. So first, for perspective, I think the note was released before Friday's measure, before yesterday's measure came in, which actually sort of stopped the
Yeah.
arbitrage or the speculative sort of action that was happening between the onshore and the offshore market. The other important perspective is that they have stopped the rebooking of contracts, forward contracts. So that's another very important step that the RBI has taken. And consequently, from a 95, 60, 65 odd closing, sort of 94, 80 odd closing at the end of the financial year, we actually have bounced back to around 93, 40 at this point in time. Now, slightly these sort of 97 may actually be revised lower. But having said that, I think structurally the upward journey in terms of the currency markets continue. The INR continues to depreciate. And as I think Abhishek was explaining, the market is pricing in a protracted war, which necessarily means the elevated oil prices. India oil basket is actually significantly also higher than the Brent or the WTI. I've never seen that happen very significantly in my through my career. So that's something that needs to be also priced in by the market. The fiscal actually has opened up to a lot of absorption of these sort of externalities and not passing it on to the macro. And for the currency markets, I think if I price oil at around $75 to $85 a barrel as an average, which is also a very very sort of an aggressive assumption that we have taken, that oil will come back there. Let's see what happens. But even then, we actually have a $40 to $60 billion in terms of a deficit in terms of the balance of payments. So that's also possibly the reason why the RBI acted, given the sense that if the balance of payments deficit opens up that wide, the amount of foreign currency assets that the Reserve Bank holds at this point in time may prove to be insufficient to fight the currency depreciation. So yes, again, journey of the currency remains relatively on the higher side. So 93.40 today may actually move gently higher. The pace of depreciation may be lowered because of the RBI action, but the fundamentals have not really changed and is unlikely to change till we see a clarification in terms of the West Asia crisis.
Okay, take your point. If not 97, what is the range that you will consider for the better part of this year, Indranil?
It's a big call sort of to take, but as I said, the currency would depreciate, and I would expect about a 3.5% depreciation going into the current financial year. That's general fundamentals any which ways. And we have seen a depreciation of about 10% in the previous financial year. I don't think we are going to repeat that because of the steps taken by the Reserve Bank of India. But we can definitely see about a 3.5% depreciation in the current financial year. So that probably takes us to a 95, 95, 50 sort of a zone in terms of the INR.
Okay. So gentlemen, that's on the currency. Now I want to widen the discussion to the rest of the issues and the rest of the macro implications of this war, which as of now is continuing. And I think most of the commentators that at least I've spoken to have maintained that forget about going back to $60 on oil or $70. Most projections right now are saying that we probably have to look at a range of $80 to $90 as an average for this year. Now, first of all, tell me if you agree on this. And then if that is the new reality, then what are we talking about in terms of fiscal deficit implications, current account deficit implications, and then we'll come to then the market pricing in those assumptions. So Indranil, on this first, current account deficit, which was so well behaved up until this war, what happens? And fiscal deficit, what happens?
So current account deficit in the previous financial year, our calculations were about 1% of GDP. At $65 a barrel, which we were assuming before the crisis broke out, we were about a 0.7% CAD GDP for FY27. But given the oil range that we are also considering, which is 85 to 95, the current account deficit is 1.6 to 2%. Now, even before and in the previous financial year, when the current account deficit was contained, we had a problem in terms of the capital account. So if I consider the actual data that is there with us at this point in time for the first 3 quarters on the balance of payments, the balance of payments surplus was absolutely zero, even though the current account deficit was relatively lower, which means that the stress on the capital account was there, and that continues for the FY27 with a worsening current account balances. On the fiscal, as I said, the fiscal has already started to absorb a lot of the negative implications of the West Asia crisis in terms of reducing the excise duties, the fertilizer subsidies, as well as higher LPG subsidies need to be considered by the government. But having said that, I think what may actually happen is during the second supplementary grants that they took out in the previous financial year, they had built a 1 trillion of a buffer within their accounting system, and that can be used to fight this current crisis. So my bet is that the fiscal worsening could be about 0.2 to 0.4%, depending on how long this conflict continues and what is the pace at which the oil prices move up or sort of remain steady. We'll have to see that. But from a funding perspective, I think I'm still not sure about whether the whole amount of the funding of the additional fiscal deficit will be taken through the gross borrowing program. But having said that, I think the fiscal worries are getting reflected in the bond yields, apart from what Abhishek also possibly rightly pointed out, that the markets are pricing in higher rates from the Reserve Bank through the course of FY27.
Abhishek, so coming back to you, how much of this has already been priced in by the market in the last 1 month, and how much more to go?
So if we just look at in terms of repo rate, I think at least 100 basis point rate hike is already there in the prices. So now the question is whether the RBI is actually going to
100 basis points rate hike, huh?
Yeah.
So you're saying the market right now is assuming 100 basis points rate hike from the Reserve Bank of India. That's an important point to note. Do you think that'll play out?
I have my doubts that it is actually going to play out, because it is largely to do with external shock. And if you act on external shocks and actually slow down the economy even more, So the job becomes even more difficult for you because inflation is not going to come under control because of your actions, and the economy, which was as it is on the boundary line, is going to slow down further. So history have suggested that if we act on these lines, then probably the job becomes difficult in the forwards, and you may have to act double what ideally you would have in terms of rates in order to contain the slowdown in the economy.
Okay, so for people who are watching this, and most of the viewers are investing in markets, either equity or fixed income, or many times both. I want to ask both of you gentlemen, Indranil. Now, this is an unfair question to an economist, and by the way, we're getting to the policy next week. So tell us,
Yes.
what would you expect from the RBI in terms of either signaling, body language, just commentary? Would they be preparing the market for higher rates ahead? And even if that happens, will the market react? Because it's like Abhishek is saying, I mean, the market's already priced in 100 basis points rate hike, so it shouldn't come as an additional shock. The equity market has fallen so much, bond yields have risen so much. So what to expect next week?
No, I think we will have quite an interesting policy because the transition from the February policy to the current policy has been quite significant. When we heard the Reserve Bank in the February policy, had just started seeing the impact of the West Asia crisis, and today the West Asia crisis is in a full-blown mode. So I think the policy would be cautious rather than being outrightly hawkish. And I think I would side with Abhishek in the sense that they can't kill growth. So they have to do a very tightrope walk between growth and inflation. Now, when the household expectation survey came out in the February policy, we had seen an increase in the household expectations based on food prices. We will have to watch out how the household expectations surveys behave. And yes, this is a supply side shock in terms of an inflation that we will have to deal with. The question is whether the RBI would want to react on a supply side shock. My perspective is that immediately they won't. But if the inflation expectations and the real inflation, the actual inflation numbers tend to surprise on the higher side, along with factors such as El Nino, which is being expected, that is the point in time the RBI might actually sort of come and first tighten liquidity and then hike rates. So I think this is more a back-ended sort of trajectory that we are looking at, somewhere around the October to December rather than immediately.
Indranil, very quickly, last 10 seconds on this. On inflation itself, do you expect that we will get a full year projection from the RBI, or could they put it on hold because of the war and too many moving parts? And do you have a projection, inflation for FY27?
RBI had definitely promised that they would put out a projection. And even if I read the state of the economy, the last state of the economy, they had said that they will be coming out with a full sort of an analysis in terms of the crisis and what its implications are for the macro. Our projections without building in the oil crisis is a 3.8% for FY27. Upside of 35 to 50 basis points, given that a 5% depreciation leads to a 30 to 35 basis points upside in inflation. Farm input prices as well as manufacturing input prices have tended to go up, which necessarily means that there could be a pass-through, if not 100%, to the end users. But the important thing is that the pump head prices of petrol and diesel still hold, which necessarily means that the implication of the higher oil prices globally translating into higher CPI has been actually truncated to a certain extent. So again, my bet would be without anything, 3.8 upside of 35 to 50 basis points. At the outside, I think 4.5% would be my inflation, which is not too bad from an RBI's perspective, given what is happening globally.
Yeah, that doesn't sound like much of a shock at a point when you've had a full-scale war and you've seen oil prices surge over 60% in the last 1 month. 4.5% inflation. It sounds, I mean, to me, as just a bystander, sounds like a very resilient economy. But a quick final question, Abhishek, with you. What is the advice that you'd leave our viewers with? What should they be doing in the fixed income markets? Where to invest? What to avoid?
I completely agree with Anil in terms of inflation. If you look at the overall numbers, doesn't look as bad, given you expect the economy to grow at around 6 to 7%. A 4.5, 5% kind of inflation number is very much acceptable, and it's a healthy number as well. So, as far as advice to the investors are concerned, yes, there is this volatility all around the asset classes, and the least volatile in relative terms will be the fixed income. And in fixed income, you can obviously choose the ultra short term or short term kind of strategies where the duration is somewhere around one, because markets are already pricing in, as I explained it to you, and the YTMs are fairly attractive given the risk reward. At 5 quarter, repo rate, we have hardly seen ever that the YTMs of the ultra short term products in the range of 7 quarter to 7.5. So, which is a decent deal given whatever is happening, real rates or absolute returns or volatility, whatever metrics you want to apply. The ultra short and short duration funds are offering reasonable risk reward. At the same time, if you just look at the extreme longer end at 8% is also offering a reasonable amount of value for the long-term investors. If you have tolerance to volatility, because traditionally retail investors have been investing largely into equities, and equities have been significantly offered higher volatility. So for your long-term investments, one can even consider the long-term fund as well, because the funds have yields have just gone through the roof and discounting much more than what RBI actually is likely to deliver over next 6 months to 1 year.
Okay, that's an important point. So we are coming out of this conversation feeling a little more reassured that all is not lost on macros and things seem to be fairly contained, at least at this point in time. One can only hope that this war winds down quickly. Gentlemen, thank you so much. Very informative discussion, very insightful. Helps our viewers really understand what's going on with the money markets. Thanks for joining in.
Thank you.
Thank you. Okay, so that is the money market conversation for today. The equity market is really not feeling good. There's such a struggle right now to hold on to 22,200 on the Nifty. The Nifty continues to be, down by more than 470 points. Look at that. It's just a complete slide. And all of yesterday's gains wiped out in a flash. Okay, we have, before we go, we have an exclusive, Moneycontrol exclusive for you in terms of what's happening on Deal Street. It's a very interesting story on what is going on with DFM Foods, a company that makes cracks. If you're from North India, you'll be very familiar with cracks. And I'm going to get my colleague Ashwin Mohan to join in on this in just a bit. But in the meantime, just a quick detour. Check out what the US president had to say, because all of the market mayhem this morning is courtesy those comments that came in at 6:30 a.m. our time. Check out the US president's commentary, and we'll be back with that Moneycontrol exclusive in the next 1 minute.
We are systematically dismantling the regime's ability to threaten America or project power outside of their borders. That means eliminating Iran's navy, which is now absolutely destroyed, hurting their air force and their missile program at levels never seen before, crush their ability to support terrorist proxies, and deny them the ability to build a nuclear bomb. Our armed forces have been extraordinary. There's never been anything like it militarily. Everyone is talking about it, and tonight I'm pleased to say that these core strategic objectives are nearing completion. The United States imports almost no oil through the Hormuz Strait and won't be taking any in the future. We don't need it. We haven't needed it, and we don't need it. We've beaten and completely decimated Iran. They are decimated, both militarily and economically and every other way. And the countries of the world that do receive oil through the Hormuz Strait must take care of that passage. They must cherish it. They must grab it and cherish it. They can do it easily. We will be helpful, but they should take the lead in protecting the oil that they so desperately depend on. So to those countries that can't get fuel, many of which refuse to get involved in the decapitation of Iran, we had to do it ourselves. I have a suggestion. Number one, buy oil from the United States of America. We have plenty. We have so much. And number two, build up some delayed courage. Should have done it before. Should have done it with us, as we asked. Go to the Strait and just take it. Protect it. The hard part is done, so it should be easy. And in any event, when this conflict is over, the Strait will open up naturally. Thanks to the progress we've made, I can say tonight that we are on track to complete all of America's military objectives shortly, very shortly. We are going to hit them extremely hard over the next 2 to 3 weeks. If there is no deal, we are going to hit each and every one of their electric generating plants very hard and probably simultaneously. We have not hit their oil, even though that's the easiest target of all, because it would not give them even a small chance of survival or rebuilding. But we could hit it, and it would be gone, and there's not a thing they could do about it. We have all the cards, they have none. It's very important that we keep this conflict in perspective.
Okay, all right, so that was the US president there, and those comments not going down well with global markets, all of the markets around the world, around asset classes in a tailspin. But we're going to take a bit of a break from all the market action and focus on the deal action of the day. And as promised, I have my colleague Ashwin Mohan now joining in. And he, as usual, has an exclusive story up his sleeve. Ashwin, morning. Thank you so much for being with us. And we could really use with this breather too much of market volatility and mayhem. But you have a very interesting story around cracks. I know cracks very well. I grew up in Delhi. DFM Foods is the company. It's listed. Tell us what's brewing.
That's right, Surabhi. So, West Asia crisis or no West Asia crisis, M&A action is continuing unabated back home in India. The target firm, as you correctly pointed out, is DFM Foods. It's a portfolio company of global private equity firm Advent International. Now, Advent had acquired DFM Foods back in 2019 for around $120 million. And then, interestingly, a few years later, in Jan 2023, they delisted DFM Foods. So as of now, it is a delisted entity. What we're given to understand from our sources is now, post 6 years of their investment, Advent International, and of course, it's a private equity firm, so it's going to look at an exit. They are currently in exit mode. We are given to understand from sources that Advent is evaluating a sale of DFM Foods. They have kickstarted initial discussions with investment bankers, and very soon we hear from our sources that they are all set to appoint the sell-side advisors for this deal. Now, yes, you hit the nail on the head. As far as DFM Foods is concerned and Cracks is concerned, it is a brand which has strong visibility up north. Almost 70 to 80% of the revenues of this firm come from the northern market, though in the recent past, it has been diversifying into other areas as well, especially the eastern market. Now, what sources are telling us is that both private equity firms as well as strategics could be looking at this asset, especially any strategic that wants to bolster or improve its presence in the northern market. As far as valuations are concerned, what we're given to understand from our sources is that Advent International is expecting anywhere between 500 million to 800 million for this asset. But, these are initial days, and, the valuations haven't yet been finalized, and they may vary later based on market conditions. But this is a big deal, Surabhi, brewing in the sector. The larger theme, Surabhi, is that this is not the only snacks deal that is in the works, right? It's the entire food space. There's a lot of action cooking in the entire food space. Last year, we saw Haldiram. Then we saw a deal in Balaji Wafers. Then look at the Western Desert segment. That's also part of the food space. You saw deals in Theobroma. That's a Western Desert transaction. You saw deals in Belgian Waffle. We reported recently that there's also another stake sale going on at this popular desert firm called Madover Donuts. And the entire food space is really buzzing. QSR as well. We had that big bang merger between Sapphire Foods and the other entity that falls under the Yum brand that consolidated the entire KFC and Pizza Hut portfolio in India. So therefore, this is a space, especially in the consumer segment, the food space, that is buzzing with a lot of deal activity. And the latest, of course, is DFM Foods. Let's wait and watch to see how this pans out in the days to come. Surabhi, back to you.
All right. Appetizing for sure. Lots of deal action over there. And DFM Foods is the company in question right now. Very interesting story, Ashwin. Thank you so much for getting us all the details and, as usual, keeping us on top in terms of what's brewing on Deal Street. Thanks for joining and have a great day. Catch you soon. All right. Well, with that, we're completely out of time on today's edition of Opening Bell. Thank you very much for watching. And as we sign out, we're going to, leave you with some of the global commentary and the global developments around the geopolitical situation in West Asia. Tensions have been escalating on the global stage. Keir Starmer and Donald Trump have locked horns over the Iran conflict. The UK Prime Minister has made it clear that this is not UK's war. He has signaled that Britain will not be drawn into a conflict that does not serve its national interests. On the other hand, Donald Trump has taken a hardline stance. He's been constantly calling out NATO allies for not doing enough. And he's saying now that those who use the Strait of Hormuz should go out and take it and make it operational on their own. Listen in, and thank you so much for watching.
The conflict in the Middle East has now entered a second month. And while we're working at pace for de-escalation and peace, it is now clear that the impact of this war will affect the future of our country. So today I want to reassure the British people that no matter how fierce this storm, we are well placed to weather it, and that we have a long-term plan to emerge from it a stronger and more secure nation. This is not our war. We will not be drawn into the conflict. That is not in our national interest. And the most effective way we can support the cost of living in Britain is to push for de-escalation in the Middle East and a reopening of the Strait of Hormuz, which is such a vital route for energy.
The United States imports almost no oil through the Hormuz Strait and won't be taking any in the future. We don't need it. We haven't needed it, and we don't need it. The countries of the world that do receive oil through the Hormuz Strait must take care of that passage. They must cherish it. They must grab it and cherish it. They can do it easily. We will be helpful, but they should take the lead in protecting the oil that they so desperately depend on. So to those countries that can't get fuel, many of which refuse to get involved in the decapitation of Iran, we had to do it ourselves. I have a suggestion. Number one, buy oil from the United States of America. We have plenty. We have so much. And number two, build up some delayed courage. Should have done it before. Should have done it with us, as we asked. Go to the Strait and just take it, protect it, use it for yourself.